Welcome to this video, and in this video we are going to discuss about adjusted present value. In adjusted present value, we are looking at how do we incorporate the financing effect on our investment decision. So in this video we are going to look at how to incorporate the financing effect on investment decision and then evaluate an investment. So we are looking at adjusted present value. So what I can say that some of the terms that we are going to use in this video can be found in my video of capital structure. So in this video we are looking at how do we incorporate the financing effect on our investment appraisal. We know that a business can finance its activities either using equity or using debt. So if a business, you have got an investment project, and that project you are going to use two sources of finance, you are going to use both equity and finance, then we need to look at the effect of financing on your investment appraisal. So that is what we refer to as the APV. How do we incorporate the effect of the finance or financing effect on your investment decision? So I want you to take you through briefly some of the terms within a financing effect. If you look at our capital structure theory, or if you look in my video of capital structure, you are going to find the Modigliani and the Miller theory. The Modigliani and the Miller theories, they try to explain how the financing effect, or how the way you finance your business, whether the way you finance your business has got an impact on the value of that business. So in Modigliani and Miller, 2 with tax. First, if you look at Modigliani and Miller 1 with tax, it says the value of a GRD business is equal to the value of an GRD business plus the present value of the debt tax shield. Meaning that the way you finance your business, it has going to have an impact on the value of that business. And still, if you look at Modigliani and Miller 2, the Modigliani and Miller 2, which is about it is about on the cost of equity. So the Modigliani and Miller 2 say the cost of equity is equal to the cost of an GRD business plus the risk premium times the debt shield, and then you look at the ratio of debt to equity. So meaning that the way you are going to finance your business, it's going to affect your cost of capital, and it's going to affect the value of that business. So in adjusted present value, we try to look at that effect in our investment appraisal, and then we adjust the financing effect on our investment appraisal to get the adjusted present value. So as I illustrated in my previous video, that the main component that makes up we are looking at this, the effect of financing on your work and the effect of financing on the value of that business. So as I said in my previous video, that if you look at the Modigliani and the Miller theory, Modigliani and the Miller 1 with tax, it says that the value of a business that is geared is going to be equal to the value of a business that is not geared plus the present value of debt tax shield. So the value of a business which is geared will be more than the value of the business with this. So that is the main interest we are looking at as far as the the adjusted present value is concerned. So if you are using equity and debt, then we need to also to look at this part in our investment decision. Then if you look at still Modigliani and Miller too, we are going to look at this, that the, the cost of equity or the work is going to be affected by the way the business is financed. And in this case, we are looking at the cost of equity, as we can look at it in our previous, which is equal to the cost of ungeared plus, oh, this is a bracket, cost of ungeared minus cost of debt into 1 minus t and then the debt tax shield. Meaning, the way you are going to finance your business, it's going to affect your cost of equity, and which is going to automatically affect the work. So in the adjusted present value, we are interested in this. We are interested in the cost of capital, which is our work, and we're also interested in this part that we have talked about. So let's look at the stages when we are computing our adjusted present value. The first stage is to evaluate the project as if it was equity financed. This is the important part. Meaning that when you are discounting your cash flows, you are looking at the cost of a business that is not geared. 100% that business is equity, meaning there is no gearing. And when we talk of gearing, because these are terms that are found in my video of capital structure, when it comes to gearing, we are looking at the combination of debt and equity. So if we say the business is not geared, which we abbreviate as G, it means that business is financed by equity. If you say that the business is not geared, it means that business is financed by equity. So in your first step, you are going to determine the net present value of the cash flows, but using a cost of a business that is not geared. That's the first step. Now, once you get the present value, meaning, please, I want you to get this. Your first step, you are going to determine the present value or the net present value of that project. But when you are discounting the cash flows, you are going to discount the cash flows using a cost of an ungeared business. Because we are looking at the net present value of a business that is not geared, which is financed by equity 100%. Now, once you finish that, then you adjust for the effect, the financing effect. In this case, we are interested to get at the present value of the debt tax shield. Remember that when you are financing a business using a debt, the interest you are getting on the debt is tax arrival, meaning that if you are financing a business using a debt, there is always a tax saving that is got on that debt. So we look at the present value of that debt tax shield associated with financing a business using a debt. Now, the third step, which is our last step, is to get our APV. And to get our APV, you are going to get the business, the NPV of a business that is not geared, then plus the financing effect, which is the present value of our debt tax shield. Then you get our APV. So these are the 3 steps that you can go through when you are calculating adjusted present value of the project. So I want us to go through this, the first step we have talked about. Our first step, we said you are going to get the net present value of the project as if that project is 100% financed by equity. As I said in my earlier slide, is that in this case you are getting the NPV of a business that is not geared. And when you are getting the NPV of a business that is not geared, in this case, you are supposed to discount your cash flows using a cost of capital that is not of a business that is not geared. So that is what we are going to first look at. You are going to use the cost of equity for a business that is not geared. Now, sometime, as I said, you need to know some of these issues. So you need to know how to adjust the cost of a business that is, because this is what we need when we are discounting our cash flows. So if you have this, the cost of equity of a business that is geared, then it means you need to apply the Modigliani and the Miller 2 theory with taxes. So if you apply Modigliani and the Miller 2 theory with taxes, then you can be able to get the cost of ungeared. It is going to depend on the information that you are given. So if you have been given a cost of equity which is geared, this is the cost of equity of a geared business, then it means to get the cost of ungeared, you are going to apply this, and then from here you can be able to adjust and then determine the cost of equity that is ungeared. So when you get the cost of equity which is not geared, then you are going to apply it here. You are going to apply it here to get the net present value of a business which is not geared. But sometime a question can provide you with equity beta, what we call the equity beta, BE. So, for example, if you are using the capital asset pricing model, if you're using the capital asset pricing model and you are supposed to get the cost of equity of a business that is not geared, in that case, it is going to be the cost of business, the cost of equity of a business that is not geared. I think I should put this. Will be equal to, if you are using the capital asset pricing model, it will be equal to our risk-free plus beta of asset beta. This we call it asset beta. This one is what we call the asset beta. Then into market return minus our risk-free. So what I want to explain here is that if you have got an equity beta, then you can be able to adjust using this formula to get an asset beta. What do we mean by equity beta, asset beta? When we say asset beta is the beta for a business which is not geared, which is financing using equity, that will call it an asset beta. But when we say equity beta, it is for a business that is geared. It is using both equity and debt. So if you have got an equity beta, then you can be able to adjust using this formula to get an asset beta. Once you get an asset beta, then you can apply the capital asset pricing model to determine the cost of equity of that of business that is not geared using an asset beta. So once you get that, so it depends on the information. If you have this, you can use the Modigliani and the Miller 2 theory to be able to adjust and get the cost of ungeared. But once you or if you are given an equity beta and you have the risk-free rate and the market return, then you need to adjust to get the asset beta and then apply into the capital asset pricing model to determine the cost of the equity of a business that is not geared. So this is our step number 2. We have looked at step number 1, and step number 1 we said you need to get the net present value of the project. But when you are getting the net present value of that project, you are discounting your cash flow with a cost of capital that is not geared, meaning you are using the cost of a business which is 100% equity. If you have a cost of equity that you have a cost of equity, but the business it is combined with a debt, then you need to adjust to get what called the cost of an GRD business. And we have seen that when you are adjusting to get the cost of an GRD business, then you are using the Modigliani and the Miller tool with taxes. Now, step number 2, we need to adjust, or we need to look at the effect of the financing to our business. So remember, we are looking now at Modigliani and the Miller 1. The Modigliani and the Miller 1 with tax says that the value of a GRD business, this is the value of a GRD. When I said, remember I said, if you say the value of a GRD business means that business is using a debt. It's equal to a value of an GRD, a business that is not using a debt, plus the present value of the debt tax shield. And I said that if you are using a debt, you are paying interest on the debt. So the interest you pay on the debt is tax deductible. So because the interest we are paying on the debt is tax deductible, the business is making a tax saving. So this tax saving is the one that we are supposed to discount. You discount the tax saving using the cost of debt. You are discounting the tax saving using the cost of debt to get the present value of the debt tax shield. I think I should repeat this. I said that when you are calculating using the Modigliani and the Miller 1 with tax, that a business that is geared is equal to the business that is not geared, or the value of the debt that is not geared, plus the debt, the present value of the debt tax shield. And what makes this present debt tax shield? The debt tax shield is made by the interest the business is paying on the debt. Because we said the interest on the debt is tax allowable. So meaning if the interest on the debt is tax allowable, then we are interested in the tax saving you are making by employing a debt in the business. So we are going to discount this. It means to get the present value of this debt tax shield, you are going to discount your tax saving. You must discount the tax saving. And when you are discounting the tax saving, you should use the cost of debt. We shall look at other issues related to this. But when you are discounting the debt tax shield, you should use the cost of debt. So how to get this? We are looking at the interest, the present value of the debt tax shield, then times the corporate tax. And the tax shield that we are talking about here is the interest the business is paying on that debt. So once you get that, then you can get the present value of the debt tax shield. So our step number 3, once we have finished the other ones, the step number 3 is to add. You are now getting your adjusted present value. You get the adjusted present value, which will be the step number 1, which is the net present value of a business which is not geared, meaning the one you got in step 1 where you discounted using a cost of an geared business. Then plus the present value of the debt tax shield that you have got in step 2. Then you can be able to get your adjusted present value. Let's look at this example. The project costing this. So this is our initial investment, IO. to be financed by 6,000 irredeemable debt. Don't worry, we shall look at those terms. This is our debt, and this is the interest on this debt, our R on the debt, and then a loan stock. This is the loan stock and the 40,000 new equity. So this is our equity. The project we read and after tax, this is our cash inflows. This is our cash inflow. Cash inflow. And it is in perpetuity. If you remember in my first video on investment appraisal, which was time value of money, we know what we mean by perpetuity. Means is forever. It is forever. And we said to get the present value of a perpetuity, we said you get your constant. If you said as the PMT, you get the constant divided by R. If you are getting the constant, the present value. So our if it were all financed, this is very important. If it were all equity financed, this one, meaning if the business was all equity, does not have a debt, so meaning this is the cost of an GEAD. This is the cost of an GEAD business. An appropriate cost of capital will be this. This is our tax. Our tax. Then what is the project adjusted present value? So we can just get, remember the first step, as we said, your first step is to get the net present value of an GEAD business. And when you are getting the net present value of an GEAD business, we said you are discounting your cash flow using the cost of an GEAD business. So in this case, remember our cash flows are perpetuity. We are getting 21 divided by our cost of an GEAD business minus, because we are getting the net present value, minus our initial investment of 100,000, then we get 40 as our net present value. So this is the NPV, which is an GEAD. Now we need the present value of a debt tax sheet. So the present value of the debt tax sheet is going to be the interest we are getting. So our interest, it's going to be 60,000 times 12%. So if you get this, then times 30% to get the tax saving on that interest. So then after that, because the cash flows are perpetuity, you divide it by 0.12, which is the cost of debt. Then you get 18. So meaning our adjusted present value will be the net present value of an GEAD business plus our present value of the debt tax sheet. Then you get 58. This is the 58,000. So let's look at another important part, which is the sometime a company may issue a debt, but in the issuing of a debt, there are some costs that a business may incur, what called the issue cost. So if the company has incurred some cost, then those costs should be considered when we are computing our adjusted present value. So what we need to know is whether those costs are tax allowable or they are not tax allowable. So if the costs are tax allowable, then you need to look at the timing of the cash flows of those tax each cost. So let's look at this example. ATED is about to start a project and the investment is 20 million. This is the amount required for the investment. That is our initial investment, IO, which will generate cash flows cash flows over 4 years. So this is our N. This is our N. The project will be financed with a 10 million. This one is our debt. A 10 million loan, and the right issue costs are 5%. And a right issue is going to be financed by a 10 million bank loan and a right issue. The issue cost are 5%. This is our issue cost. It is 5%. This is our issue cost of the debt, 5%. Then calculate the issue cost that will be used in the APV calculations. So in this case, remember this debt, we have 10 million. And you need 10 million. And this 10 million, there is an issue cost of 5%. So what is the 5%? What will be the issue cost? So when we are getting the issue cost, remember this 10 million is going to represent 95%, because there is always an issue cost. This 10 million is representing 95%. So you are looking at 5% of the 95 times the 10 million, then you can get the issue cost. So that will be the issue cost to consider in your debt. So another important thing that we can talk about is when we are discounting the tax relief at a risk-free rate. In the questions, if it is an examination question and you are given a cost of debt, although there is a contradiction still controversial on the theory, if you are given the cost of debt and you are also given a risk-free rate, then the tax saving or the tax relief that allowed by the government should be discounted using a risk-free rate. Please, I want to repeat you for this to be able to grasp it very well. In an examination question, if it is an examination question and the question has given a cost of debt and a risk-free rate, so because the government has given a relief, we consider the relief as a risk-free. So meaning that when you are discounting the tax relief given by the government, you should use what we call a risk-free rate. Another important thing that I can talk about still on the issue cost. If the issue cost is allowed for tax, then you need to calculate a tax saving on the issue cost. I want you to repeat. If the issue cost is allowed for tax purpose, if the question maybe specifies that the issue cost is allowed for tax purpose, then when you are calculating, you must recognize the tax saving on the issue cost. But still be very, very careful. Be very careful on the timing of the tax. When are you supposed to pay tax? Are you paying in earlier or you are paying in advance? Automatically, if it is an issue cost and there is no tax, we don't discount, because the each cost is going to be at time 0. So we don't discount. But if there is a tax, you need to be very careful and identify the timing of those each cost. So this is a solution to our previous example that we have talked about. We had the 5%, and I remember I said the 5% on 10 million. This 10 million is already 95%, because when you issue a debt, if you want 10 million, this 10 million you must get it after you have removed the each cost. So meaning that this one is already 95%. So what we need is to get the each cost. So the each cost is going to be 5% or 5 over 95 times the 10 million. I think it's a simple calculations, and they get our each cost. Unless you have been told that the each cost is allowed for tax. But if the each cost is not allowed for tax, we consider the each cost to be in time 0. So since it is in time 0, then the discount rate is going to be 1. So you don't need to calculate this. But if it is allowed for tax, then you need to know when is the timing for the each cost, the timing of tax. So in our previous example, we are assuming that the tax is 30%, and this tax is payable in arrears, meaning the tax of year 1 is paid in year 2. So if this tax is paid in arrear, and we are saying and our each cost is in period 0, it means the saving will be recognized at the end of year 1. So we are going to look at the discounting factor of year 1. So in this case, and we have been given a risk-free rate. So it means we are supposed to discount our each cost, or our saving on each cost, using a risk-free rate of 8%. So the tax effect will be the tax rate times our each cost, then times our discount rate, and then you get the present value of our each cost. So that is what we can talk about as far as the adjusted present value is concerned. Please, we have talked about 4 important things in this, or 4 or 5. The first, I said you need to, because adjusted present value, you are incorporating the financing effect on a project. So if you are going to finance a project and you are going to use a debt, then you need to look at the effect of financing using a debt on the project. That is the adjusted present value. Then we have looked at the steps where we said your first step is to discount your cash flows with the cost of an geared business. You are assuming the business is 100% equity. Then you discount your cash flows using the cost of an geared business. Then step number 2, we have said you look at the financing effect by calculating the present value of the debt and of the debt tax sheet. And our debt tax sheet is the interest that you are supposed to pay on the debt, or the interest rate. So we get the interest times the tax rate, then we get the tax saving. Then we discount that tax saving using a cost of debt or using a risk-free rate, depending on the question that we have been given. Then the last part is to get the adjusted present value, which we said you are getting the net present value of an geared business plus the present value of the debt tax sheet that you calculated in step 2. Then another issue I've talked about in this part is the each cost. sometime when you issue a debt, you are going to incur cost on issuing that debt. So the cost of the debt is going to affect your cash flows or your present value. So if there is the issue cost is allowed for tax, then you need to recognize the issue cost on your debt when you are calculating your present adjusted present value. So that is what we have discussed in this video. Please don't forget to subscribe to my videos such that you can be able to watch my videos as I issue them out. Thank you very much for watching this video.